Managing your own emotions might be the hardest job in all of finance. How do you navigate that roller coaster of fear and greed when your own money is on the line? I'm going to show you exactly how. If you're an investor right now, you're probably caught in a classic dilemma. The S&P 500, that's the index tracking 500 of the largest U.S. companies, has posted 3 straight years of double-digit gains. Part of you feels that pull of FOMO, fear of missing out. But the other part of you? Every headline seems to scream about some crisis just around the corner. Which feeling is right? This is exactly why this comparison matters so much. On the left, the newsroom chaos. Financial media leans negative because scary stories get clicks. Weak jobs report. Economic doom is coming. But on the right, the hidden realities. Strong corporate profits. Potential rate cuts ahead. Tax tailwinds. The real picture is often much brighter than the headlines suggest. How do we tune out that noise and focus on what actually matters? It starts with finding real, durable sources of value. And that brings us to one of the most overlooked parts of investing: dividends. Right now, dividends have become the Rodney Dangerfield of investing. They get no respect. All the attention goes to flashy growth stocks, or the higher yields from money market funds. Those are basically super safe, cash-like investments. The current dividend yield on the S&P 500, about 1.2%. Not exactly heart-racing, is it? Why should we care? Because of this. Over the last century, compounded dividends, meaning dividends you reinvest to buy more stock, have accounted for 37% of the S&P 500's total return. That's not a rounding error. That's a massive engine of long-term wealth hiding in plain sight. But here's what really matters for managing fear. Look at this track record. During the crash of 1973-74, the market fell almost 50%. Dividends held steady, didn't decrease. During the dot-com bust, market tanked. Dividends barely dipped. In every recent panic, dividend payments actually kept rising. That reliable cash flow is a powerful anchor in a storm. Dividends give us a stable foundation to fight off fear. But we need a second tool to keep our other emotion in check: greed. And that's where rebalancing comes in. What is rebalancing? Simply put, it's a rule-based system for managing your portfolio. Here's a real example of rebalancing from last year. We owned several artificial intelligence or AI stocks: NVIDIA, AMD, Broadcom, Alphabet, better known as Google, and Amazon.com. They ran hard. NVIDIA went from a 4% position to 9%. AMD doubled. It went from 4% to 8%. These 5 names alone grew to 30% of the portfolio. That's too concentrated. Our max position size is 6% at cost, and several of these stocks' prices had climbed above our estimate of intrinsic value, but still below our sell above price. So we trimmed, sold them back down to 4% each, brought that 30% AI allocation down to 20%. Now here's the key part. What did we do with the proceeds? We rebalanced. We bought stocks that the market was punishing unfairly, in our opinion. Eli Lilly and Novo Nordisk had gotten hit hard early in the year. Both were trading well below intrinsic value. We bought. Salesforce was taking a beating. The market thinks AI will hurt their business. We disagree. We think Salesforce will become one of the main places companies go to actually implement AI. Same thesis with Accenture, down big, so we added there too. That 10% we trimmed from the winners went straight into these undervalued names. This is what rebalancing looks like in practice. You don't just sell high and sit in cash. You sell high and buy low, rotating from positions that have stretched beyond fair value into positions the market has left for dead. Here's why this matters. Rebalancing forces you to do something that feels completely unnatural. You sell a little bit of your winners. That keeps greed in check. Then you use that money to buy more of what's lagged behind. It's a systematic way to sell high and buy low. It imposes discipline right when your emotions are screaming at you to do the opposite. In fact, rebalancing, and I love this phrase, the only known antidote to the fear of missing out. It stops you from chasing hot stocks at their peak. It forces you to stay grounded in your long-term plan. Now, this whole disciplined approach only works if you trust the underlying engine of the market. Let's zoom out for a moment. This chart tells the whole story. That crazy, jagged red line at the top? That's what we see and feel every day. Stock price fluctuations, wars, recessions, bubbles bursting. That's what drives our fear. But look at that steady green path below. That represents the actual fundamentals of the businesses themselves, their earnings, their dividends, a steady, undeniable climb upward. Let me put hard numbers on that growth. Over the last 50 years, S&P 500 earnings went from about $8 per share to an estimated $270. Dividends went from under $4 to an estimated $80. That is the fundamental reality, the real engine powering the market through every single crisis. What does all this mean for you? It means boiling everything down to core principles, a North Star to guide you through any market. Here they are. First, let your goals, not the daily headlines, drive every decision. Second, the only way to capture the market's full benefit is to stay invested, even through the rough patches. Third, trust that history is on your side. Every market decline has eventually given way to a new high. And finally, maybe most important, let compounding do its work over decades. Which brings us to the perfect final thought. From the legendary Charlie Munger, the first law of compounding is never to interrupt it unnecessarily. All the tools we talked about today, focusing on dividends, rebalancing, taking the long view, they're designed to do one thing: keep you in the game. This incredibly powerful force can build your wealth, completely uninterrupted by fear or greed. Look, if you're someone who's serious about building long-term wealth through ownership in great businesses, and you want a second opinion on whether your current approach is actually serving your goals, there's a link in the description for a free strategy consultation. No pressure. We'll just talk through where you are and where you want to go. Now, if you found this helpful, you're going to want to see this video next, where I break down the specific characteristics we look for in companies that can double their share price every 3 to 5 years.